So is crypto 2026 going to be a bear market, or is it going to be a liquidity extended cycle? The things we want to look at here are the assets and how they're performing, because money flows. Gold and silver aren't written by accident. They're like a liquidity alarm. They tell us everything we need to know about the confidence in fiat and the direction of liquidity. Gold has been on an absolute run this year, up around 70%, and silver has been even crazier, roughly 140 to 150% increase, depending on the source and the exact date. And that's not normal. That's not a little safe haven bet. That's the market yelling something bigger is going on in the background. If we zoom out here on Bitcoin, we can see the validity of a 4-year cycle argument. You get a big run and then a reset. And that's why so many people are comfortable saying that 2026 is going to be a down year. And history backs it up. After the post-halving phase, you often get a year where risks stop getting rewarded. But the problem with using the 4-year cycle like a religion is we're seeing a different macro environment. The macro backdrop right now looks like a liquidity magnet more than we can stay tight forever. Because when gold and silver move like that, what they're really pricing in is the system is running huge deficits, debt needs refinancing, and the cost of money can't stay restrictive without something breaking. And what the policymakers do when the plumbing gets stressed? They don't announce we're bailing everything out. They just quietly shift policy towards keeping liquidity stable. And as you can see here, the Fed literally announced it would end balance sheet reduction starting December 1st of 2025. That's quantitative tightening ending. Not necessarily quantitative easing, but it's the end of the drain. And then you have the New York's Fed desk talking about keeping the SOMA portfolio size constant by rolling treasuries and reinvesting agency principals into treasury bills. The SOMA is the System Operating Market Account. It's the financial portfolio managed by the Federal Reserve Bank of New York that holds assets it's purchased through open market operations. So this matters because markets trade the slope of liquidity, not the label of policy. When the drain ends, the environment changes, and then you get the next layer. The next layer is the reserve management T-bill purchases. Basically, the Fed buying bills to make sure the system has enough reserves and the plumbing doesn't get seized up. So if your 2026 bear case is tightening stays tight and liquidity stays a headwind, you see why people are questioning that, because the system is already moving to stabilized liquidity mode. And the interesting part here is it's not just the US. Here's the part most crypto people don't track: global dollar liquidity. The BSI tracks dollar credit to borrowers outside the US, and it showed USD credit growth outside the US accelerating about 6% year over year in QT of 2025. So when you hear liquidity cycle, it's not just the Fed's balance sheet, it's global credit creation, the stuff that actually fuels risk assets. Now let's bring this back to crypto. So let's look at stablecoins. Stablecoins are basically on-chain liquidity. This chart here is one of the cleanest crypto liquidity gauges. When stablecoin supply expands, it usually means there's more dry powder sitting on chain, more settlement capacity, and more ability for crypto markets to actually move. If stablecoins keep growing into 2026, while traditional policy is shifting from drain to stability, that's the exact kind of setup you need for an extended cycle. And then we've got the US piece. Bitcoin is basically being adopted in the most American way possible, through financial products. ETFs turn Bitcoin into something that can fit inside portfolios, compliance frameworks, and retirement-adjacent pipes. And that's what changes the shape of cycles. Instead of pure retail blow-off mania, you get a more steady allocation demand, which means slower moves but longer trends. So at Summit, instead of arguing about whether 2026 has to be a bear market or has to be an extended cycle, we're just watching conditions. If financial conditions tighten, credit spreads widen, stress rises and liquidity stalls, that's when the classic post-cycle hangover shows up. But if conditions stay loose, credit stays calm, stablecoin liquidity keeps expanding, and BRES starts to improve after Bitcoin stabilizes, then that's not a normal late cycle setup. That's some of the ways we're going to tell what 2026 is going to look like. And these are the most important times to be paying attention. These macro environments don't come around all the time, and you have to capitalize off these kind of opportunities. It's important to be part of a community. So for those looking to take their journey more seriously in 2026 and to be part of these daily conversations we have about macro environments and all different types of markets, join the free Discord. I'll leave links to everything down below. And if you enjoyed the video, please leave a like and subscribe.